appeal now to the central bank governors, moving Godwin Emefiele. Let's listen.
Good afternoon, ladies and gentlemen. The Monetary Policy Committee met on the 19th and the 20th of September 2016 amidst conditions of persistently subdued global and domestic economic and financial environments. The committee thoroughly assessed the global and domestic macroeconomic and financial developments and risks to the domestic economy up to September 2016 and the outlook for the last quarter of the year. In attendance were 10 out of 12 members. The committee acknowledged the tepid growth performance of global output arising from legacy factors, the June 23rd Brexit vote, as well as contagion from emerging markets, weak demand, and contracting productivity. Whereas growth appears to be slowly recovering in the advanced economies, especially in the United States, the path forward remains fraught with uncertainty as long-term government bonds have nosedived to multi-year lows on expectations of looser monetary policy from the advanced economies and the continued suboptimal performance of the euro area, Japan and China. Consequently, the IMF had in July 2016 further downgraded its baseline forecast for global growth to 3.1% from 3.2% in April. The World Bank in its June 2016 report on global economic prospects showed even less optimism and gave a global output growth projection of 2.4% from 2016 from the 2.9% projected in January. The subdued global growth prospects is traced to persistently weak fundamentals, mainly in emerging markets and developing economies, mostly due to soft commodity prices, diminished investments, contracting trade, weak demand, and rising inflation. Volatility in global financial markets appear to have subsided in the second quarter of the year after a wild ride following the UK Brexit vote and against the backdrop of less likely US rate hike expectations and some stability in the crude oil market. The United States economy firmed up at a seasonally adjusted annualized rate of 1.1% in the second quarter of 2016, although with a downward adjustment of 0.1% from the first estimate of 1.2%. It is, however, still a noticeable improvement compared with the 0.8% growth recorded during the first quarter of 2016. The improved performance of the economy was attributed to improvements in private consumption spending, a robust labor market, and increased exports, even as retail sales and manufacturing output witnessed a decline. Japan's economy expanded at a seasonally adjusted annualized rate of 0.2% during the second quarter of 2016, compared with 1.7% during the first quarter of 2016. Against the backdrop of weak wage growth, uncertain global economic outlook, and an external sector that is undermined by a strong yen. Fearing that monetary policy may be approaching its limits, the government on 2nd of August approved a fiscal stimulus of 13.5 trillion Japanese yen, approximately $132 billion, in a spirited attempt to jumpstart the economy, even as the Bank of Japan dismissed market speculation that it was planning to stop its monthly monetary stimulus program of 6.7 trillion yen, approximately $69.07 billion. The massive fiscal and monetary stimulus are, however, to have the desired impact. Real GDP in the euro area expanded by 0.3%, a significant decline compared with 0.6% recorded during the first quarter of 2016. Downside risks from the Brexit vote seems to have dissipated with no attendant major economic shock to the zone's economy thus far. As such, many of the conditions that have driven the recovery have remained in place, suggesting that third quarter growth may continue in the direction of the second quarter. Following its September 8, 2016 meeting, the Governing Council of the European Central Bank resolved to leave its key interest rates on the main refinancing operations, the marginal lending facility, and the deposit facility unchanged at 0, 0.25, and minus 0.4% respectively. The Council also reaffirmed its commitment to sustain the monthly asset purchases of 80 billion euros, approximately $90 billion, until the end of March 2017, or until a sustained adjustment is seen on the path of inflation towards the 2% policy target. The Bank of England, at its August 4th meeting, and in attempts to further blunt the aftershocks of the Brexit vote, decided to cut its benchmark interest rate for the first time since 2009 by 25 basis points from 0.5% to 0.25%, the lowest ever in the bank's history. The committee voted to increase its monthly assets purchase program, financed through the issuance of reserves, by another £60 billion, approximately $80 billion, from £375 billion, approximately $502 billion, to £435 billion, approximately $582 billion. Furthermore, the Bank of England revived its financial crisis era UK government bond buying program, financed through its issuance of reserves up to £10 billion in an effort to stimulate the economy and steer inflation towards its 2% target. While major emerging markets and developing economies continue to be constrained by low inbound capital mobility, the intractable macroeconomic environment faced in 2015 and up to the first half of this year is gradually abating. The prospects for near-term full economic and financial recovery in the EMBEs remain subdued, with the IMF projected growth rate forecast for this group of countries at 4.1%, a downward review from 4.3% projected in its April update. However, resurgence of growth is expected to be powered by rising credits and a surge in government spending. The potential alliance between the OPEC and non-OPEC members like Russia to reduce quota in the face of disruptions to production in Nigeria, Libya, and Iraq have aided relative stability in the crude oil market. Global general price levels remained tapered due to sustained low oil and other commodity prices. In the advanced economies, despite the uncertainties arising from the UK referendum, accommodative stance of the zone's central banks, negative interest rates in Japan and elsewhere, as well as various fiscal stimuli, global inflation has remained suppressed. As deviations in macroeconomic fundamentals in the advanced economies and the emerging market and developing economies widened, monetary policy could continue to diverge between the two in the short to medium term. Domestic economic and financial developments. Data released by the National Bureau of Statistics in September indicated that the economy had slipped into recession following another contraction of the economy during the second quarter of 2016. The August 2016 data showed that domestic output during the second quarter of 2016 to have contracted by 0.06%. This represented a decline of 1.7% points in output from the minus 0.36% recorded during the first quarter and 4.41 percentage points lower than the 2.35% growth in the corresponding period of 2015. The non-oil sector contracted by 0.38% compared with 0.18% contraction in the preceding quarter. Agriculture, other services, education, arts, entertainment, and recreation, and information and communication grew by 4.53%, 4.32%, 2.88%, 1.8%, and 1.35% respectively. The shocks associated with energy shortages and price hikes, scarcity of foreign exchange, and depressed consumer demand, among others, apparently proved to be more damaging than expected. Recognizing the conditions which precipitated the current economic downturn were not essentially sensitive to monetary policy interventions, the MPC again renewed its call for urgent complementary fiscal policies to resuscitate production and engineer aggregate consumption. In particular, members underscored the imperatives of diversification of the economy away from oil into agriculture, manufacturing and services, as well as more efforts towards payment of salaries and arrears of public sector employees, particularly in states and local government, to revamp and stimulate aggregate consumption as part of the overall fiscal policy menu kit. On the supply side, efforts must be intensified and increase capital expenditure to reduce infrastructural deficits, improve the business environment, and spur the badly needed growth. Prices. The committee noted the headline inflation year-on-year again rose in August to 17.6% from 17.1% in July 2016, thus maintaining the upward trend since January 2016. The increase in headline inflation in August reflected increases in both food and core components of inflation. Core and food inflation have increased from 16.93% and 15.8% in July to 17.2% and 16.43% respectively in August 2016. The committee nonetheless noted that the month-on-month evolution of consumer price inflation has been less phenomenal. The headline inflation index rose by 1% in August, from 1.3% in July, 1.7% in June, and 2.8% in May, when it last rose. Similarly, the core index has been increasing at a decreasing rate since May, when it rose by 2.7%. It moderated to 0.85% in August, from 1.22% in July, and 1.83% in June. The same pattern of moderation is seen in the food index, which rose by 1.2% in August, from 1.21% in July, 1.4% in June, and 2.6% in May. The Monetary Policy Committee further noted that the pressure on consumer prices continues to be hugely associated with reforms, related legacy, and structural factors including high cost of electricity, transport, production inputs, as well as higher prices of both domestic and imported food products owing to the depreciation of the naira. The MPC expects that with the onset of the harvest season, the restrictive stance of policy, as well as the flexible foreign exchange regime, prices will begin to taper in the fourth quarter of the year. Monetary, credit, and financial markets development. Broad money supply grew by 8.08% in August 2016, compared with the July level of 10.75%. When analyzed, M2 grew by 12.12% in August 2016 against the growth benchmark of 10.98% for 2016. Net domestic credit grew by 20.09% in the same period and analyzed at 30.14%. At this rate, the growth rate of net domestic credit was above the provisional benchmark of 17.94% for 2016. The development in the net domestic credit essentially reflected the relative growth in credit to the private sector of 21.07% in the month, annualized to 31.61%. Credit to government grew by 1.99% in August 2016, which annualized to a growth of 3% compared with the benchmark growth of 13.28%. The growth in M2 was traced to exchange rate effect following the depreciation of Naira in the second quarter of the year. Money market interest rates reflected liquidity conditions in the economy. Average interbank call rate, which stood at 15% on 8 July 2016, closed at 30% on August 26, 2016. Between July 8 and 26 August 2016, interbank call rates averaged 24.95%. The rates increased to 50% on July 15, 2016. The sharp increase was attributed to the drop in net liquidity during the period. The committee noted a decline in the equity segment of the capital market as the all-share index fell by 3.51% from 28,733.9 on July 18, 2016 to 27,725.4 on September 15, 2016. Similarly, market capitalization declined by 3.55% from 9.87 trillion naira to 9.52 trillion naira during the same period. In addition, relative to end of December 2015, the indices fell by 20.06% and 3.35% respectively, reflecting the slowdown in the economy. Overall, the capital market did not show vulnerabilities to domestic and external sector developments. The average Naira exchange rate weakened at the interbank segment of the foreign exchange market during the review period. The exchange rate at the interbank market opened at 285.25 Naira to the dollar and closed at 305.9 Naira to the dollar, with a daily average of 302.87 Naira to the dollar between July 1st and August 26, 2016. The committee observed that total foreign exchange inflows through the CBN increased by 89.14% from $1.092 billion recorded in July to $2.065 billion in August 2016. This increase was mainly due to receipts of foreign flows within the month. Total outflows, however, decreased by 4.57% from $2.7 billion to $2.6 billion during the same period. Indirect efforts to deepen the foreign exchange market and stabilize the financial markets generally, a number of policy instruments were deployed since the last Monetary Policy Committee meeting, including an increase in the benchmark interest rates. Complementary administrative measures were also taken towards achieving this goal, among which was the directive to IMTOs to sell forex directly to bureau de change operators in order to improve liquidity in that segment of the foreign exchange market. While challenges remained, the committee expressed optimism that with the crystallization of current policy measures, noticeable improvements should be observed in the financial market going forward. The committee's considerations. The committee acknowledged the weak macroeconomic performance and the challenges confronting the economy, but noted that the Monetary Policy Committee had consistently called attention to the implications of the absence of robust fiscal policy to complement monetary policy. In the past, the committee also assessed the impact of its decision to tighten the stance of monetary policy by raising the monetary policy rate in July 2016. At this time, the committee understood the complexity of the challenges facing the economy and the difficulty of arriving at an optimal policy mix to address rising inflation and economic contraction simultaneously. The committee also recognized that monetary policy had been substantially burdened since 2009 and had been stretched. The committee noted with relish that new capital flows into the economy, approximately $1 billion, had come in since July, while month-on-month inflation had declined continuously since May of 2016. Against this background, members re-emphasized the need to prioritize the use of monetary policy instruments in dealing essentially with stability issues around key prices, consumer price and exchange rate as a prerequisite for growth. The MPC noted that stagflation is indeed a very difficult economic condition with no quick fixes, having been imposed by supply shocks as well as fiscal and current account twin deficits. Consequently, the policy framework must be re-engineered urgently to provide a lever for reversing the negative growth trend. While the imperative for ensuring financial system stability remains, the MPC reiterated the fact that monetary policy alone cannot move the economy out of stagflation. The Monetary Policy Committee considered the numerous analysis and calls for rate reduction, but came to the conclusion that the greatest challenges facing the economy today remains unsystematic and incomplete structural reforms which raise costs, risks, and uncertainty. The calls came mainly from the belief that reducing interest rates will spur credit growth, not only in the private sector, but also by the public sector, which will help provide liquidity to stimulate consumption and investment spending. The committee was of the view that in the past, the MPC had cut rates to achieve the above objectives, but found that rather than deploy the available liquidity to provide credit to agriculture and manufacturing sectors, the rate cuts provided opportunities for lending to traders who deployed the same liquidity in putting pressure on the foreign exchange market, which had limited supply, thus pushing up exchange rates. With respect to providing opportunity to public sector to borrow at lower rates, to boost consumption and investment spending, the committee agreed that although it was expected to stimulate growth through aggressive spending, doing so without corresponding efforts to boost industrial output by taking actions to deepen foreign exchange supply for raw materials will not help reduce unemployment, nor will it boost industrial capacities. The committee was also of the view that consumer demand for goods, which will be boosted through increased spending, may indeed be chasing too few goods, which may further exacerbate the already heightened inflationary conditions. The urgency of monetary and fiscal policy retreat along the trade and budgetary policy to design comprehensive intervention mechanisms is long overdue. The bank has since 2009 expanded its balance sheet to bail out the financial system and support growth initiatives in the economy, while stimulating economic growth and creating a congenial investment climate always is and remains essentially the realm of fiscal policy, while monetary policy in all cases comes in to support sound fiscal policy. The bank has and shall continue to deploy its development finance interventions to complement the overall efforts of fiscal policy towards reinvigorating the economy. The interest rate decisions of the bank are therefore anchored on sound judgment and fundamentals and compelling arguments for such policy interventions. The committee also feels that there was the need to continue to encourage the inflow of foreign capital into the economy by continuing to put in place incentives to gain the confidence of players in this segment of the foreign exchange market. Consequently, the committee considers that loosening monetary policy now is not advisable as real interest rates are negative, pressure exists on the foreign exchange market while inflation is trending upwards. The committee noted the positive response of the deposit money banks to the bank's call for increased credit to the private sector in between July and August. As the growth in monetary aggregate spiked above their provisional benchmarks, headline inflation continued its upward trajectory in August 2016 and now close to twice the size of the upper limit of the policy reference band. Supply-side factors including energy and utility prices, transportation and input costs have continued to add to consumer price pressures. Members emphasize that improved fiscal activities, especially the active implementation of the 2016 federal budget and payment of salaries by states and local governments, will go a long way in contributing to economic recovery. In the same direction, the committee urged the fiscal authorities to consider tax incentives as a stimulus on both supply and demand side of economic activities. Outlook. The data available to the committee and forecast of key variables suggest that the outlook for inflation in the medium term appears benign based on several indicators. First, month-on-month inflation has since May 2016 turned the curve. Second, harvests have started to kick in for most agricultural produce and should contribute to dampening consumer prices in the months ahead. And third, the current stance of monetary policy is expected to continue to help lock in expectations of inflation, which, by the way, has started to improve with the gradual return of stability in the foreign exchange market. In this light, the Monetary Policy Committee believes that as inflows improve, the Naira exchange rate should further stabilize. Overall, the major pressure points remain the challenges in the oil sector, and here we mean production and prices, output contraction, rise in NPLs in the banking system, and other financial system vulnerabilities, as well as foreign exchange shortages. The committee's decision. The committee assessed the relevant risks and concluded that the economy continues to face elevated risks on both price and output fronts. However, given its primary mandate and considering its limitations of its instruments with respect to output, the committee elected to retain the restrictive stance of policy evoked at its last meeting when it raised the monetary policy rate from 12 to 14%. Conscious of the need to allow these and other measures like the foreign exchange reforms to work through fully, he decided to retain all monetary policy instruments at their current levels. In summary, all 10 Monetary Policy Committee members voted as follows. 1. Retain the NPR at 14%, retain the CRR at 22.5%, retain the liquidity ratio at 30%, and retain the asymmetric window at plus 200 and minus 500 basis points around the NPR. I thank you for listening.
Thank you, Governor. Distinguished ladies and gentlemen, that was the decision of the Monetary Policy Committee in the communique number 109. As is customary here, our tradition, this is the time for questions. I would plead that we maintain the tradition of sticking to the content of this communique, and please, we should not attempt to make unnecessary linkages to issues that are not within the communique. Thank you very much. Just come up here if you have a question. Tell us your name and one question, please. Thank you.
Good afternoon, Mr. Governor. I'm Nancy. I am called the Monition EIT. The MPC has voted to keep all the rates unchanged, but would you explain that at this time when the economy is in a recession, the Minister of Finance has called for a reduction of interest rates during the recession? That could actually be there's economic sense to it, that when there's an economic decline, interest rates should reduce. Why did we get that call from the fiscal authorities? And as a monetary authority, you considered otherwise to retain all the rates. Then what has been the impact of the flexible foreign exchange regime since June? Because there seems, even you said it a moment ago, that the Naira has been depreciated. What has been the impact so far? The CBN is still a major player. When you go to the banks don't have sufficient FX to sell. For example, Zenith Bank does not accept Forex cash. And you don't even do FX. If I have a domiciliary account, I want to transfer to B party, I cannot do it. So how would you, with all these policies, how would it be crystallized that the economy will get out of a recession? Those are my questions.
Zenith does not do what?
Zenith does not accept cash. Zenith does not accept FX cash. If I have $200 now, I want to go and put it in my Dome account in Zenith, they do not accept cash. I think other banks do, but you don't have an interbank. I want to transfer to your Dome account, I can't do it. So it seems, how do you juxtapose that when you want people to have FX, but yet they cannot have FX? Thank you, sir.
Thank you.
Okay. We'll bring that and go there on Wall Street. Mr. Governor, sir, given the shocks from the Brexit on the pound and Europe and the electoral climate in the US, do you think, are you considering to diversify the CBN reserves in yen or other currencies? If so, how much do you intend to take to these banks to change as reserves? Thank you.
Good afternoon, sir. My name is Haris Mohammed. I write for various newspapers. One of the policies that took place with the reverse of the sale of forex to BDCs. Just on the conversation with some of them, they complain that still they are not accessing such forex as promised by CBN. And in the case of even assessing from some of the banks, they had to give them some tips on top of rates from the CBN. And they complain, even some of the CBN officials are aware of all these things that is taking place. So what is the bank doing to maybe ensure that this forex is really moved toward these people, this sector, especially now that we're talking about resuming back to schools and other things? Thank you.
Thank you.
Good afternoon, Mr. Governor. My name is Osita Okere from AIT. From your speech just found that the monetary policies, which of course have been going on for some time now, have probably been able to tackle the volatility in the FX market. Now, from your finding from the MPC meeting, could you tell us what exactly is the major problem that is making the FX market so volatile? Is it demand-based, or is it speculative based, or is it as a result of speculators? Now, if you have that answer already, could you share with us how you intend tackling this issue of volatility in the FX market?
Okay, let's take the last question.
Thank you, sir. Thank you, Governor. My name is Mataya Zokwe. I work for the Guardian newspapers. Mr. Governor, this fiscal and monetary policy retreat, we've been talking about it. And you yourself said that it is overdue. Can you share with us the difficulties you have in really having this retreat? Because the fiscal authorities are here, the monetary authorities are here. What's the challenge in having this retreat so we harmonize their nations? Thank you very much.
I'm David Malina from Bloomberg. Two very short questions. Mr. Governor, should we take it that you have paused a hiking cycle, or you might be starting an easing cycle, because we've seen the forecast for a full year from the IMF and others saying that the economy might go into recession for the first time since 1981. And are there any extra measures you have in place to reduce the spread between the interbank FX market and the parallel market? Thank you so much.
The second question, please.
Mr. Governor, are there any other measures you might want to put in place to reduce the spread between the FX interbank, the FX rate in the interbank market vis-a-vis the rate we see in the parallel market?
Mr. Governor, good afternoon, sir. My name is Oyinwa Tubara for Business Day newspaper. Your committee, like you said, suggested providing some tax incentives as some form of stimulus. Please, can you speak a little more around that? What do you mean by this?
That the fiscal authorities?
Okay, that the committee suggested providing some, that the fiscal authorities should consider providing some form of tax incentives as a form of stimulus. We'd like to know what was actually looked at.
Okay, I think the governor can take these ones. Governor, sir.
Well, thank you very much. The first question from Nancy was that MPC voted to hold, whereas the Minister of Finance has called for reducing interest rate at this time. Why did MPC decide otherwise? Well, basically, like I said, both the monetary and fiscal authorities will all have the intention to achieve growth. But the direction through which you want to achieve it may differ for as long as you still achieve the growth. The issues here, just like we read in the communique, is that when you say reduce interest rates, there are two possibilities here. You are saying because you want that to spur credit to the private sector at lower rates. Two, which I have heard the fiscal authority talk about, is that the fiscal authority needs to be able to borrow at lower rates to spend. Our own view at the MPC, because this was exhaustively discussed, and we said, well, in the past, there was a time when the MPC took a decision not only to reduce the policy rate, but indeed also reduce the cash reserve. These were intended to lower rates and encourage spending, particularly to the private sector. After we did that, the following meeting we also said, because we did not see the impact of credit to the private sector, that we needed to further reduce the CRR, because during that first session when we reduced the CRR from 30.5 to 25%, it provided an opportunity for about 1 trillion naira that was injected by the CBN into the economy or made available to the banks. Rather than loan these monies to the banks, or loan them to consumers, to agri-manufacturing and SMEs, like we said at the communique, we found that those credits went to traders who used them in demanding for foreign exchange which ended up putting pressure on the foreign exchange market. That was what happened. Subsequent to that, we said, fine, since this money wasn't deployed directly, that we were also reducing the CRR then from 25% to where it is right now, which is 22.5. That was going to provide close to about 350 to 500 billion naira through that avenue. But we said we were not going to allow the banks to really have the cash until they sent proposals to the Central Bank of Nigeria for a primary agri projects, new manufacturing projects, and other kind of projects that will spur industrial capacity and manufacturing output. I must confess that the proposals we received were mainly for purpose of refinancing the liquidity of the banks. And we thought that was not what we wanted, and that's the reason we've been a little bit circumspect about releasing some of those liquidity. But we are looking at the books. There are indeed some very few of them that have submitted proposals for agri, that have submitted proposals for new manufacturing projects that we'll be considering in due course. Now, the second part of it was that, yes, if you lower the interest rate, what that will do is that it makes it possible for the fiscal authorities to borrow at lower rates. We are saying, fine, if you borrow at lower rates to stimulate spending, what that does is that, well, yes, it stimulates demand for goods. But when you stimulate demand for goods by providing cash or money to be spent without taking action to boost industrial capacity, taking actions to boost manufacturing output, what happens is that you will see a situation where you have too much money chasing too few goods, which will also worsen the inflationary condition that we are now. And that's why we're saying the option that we would like to adopt is, while the fiscal is going ahead to spend, right, what we want to do is to say, at this meeting, retain the rates where they are. When you say retain the rates where they are, you are still saying you want to maintain the fairly tight situation, so that that will again, like we said at the last meeting, encourage inflow of capital. Because I must say, truly I wasn't that optimistic initially, but today I'm saying that I'm looking optimistic, because between July and now, we've seen inflow of FX of above $1 billion. What were these used for? These were used to procure raw materials, or manufacturers bought the dollars to import raw materials. When you import raw materials, those manufacturers that said that they were closing would have the opportunity to now employ people. When you employ people, you increase your productivity, you produce your goods, the price of goods will be moderated from the monetary standpoint. Then you find the demand that you are spurring from the fiscal authority coming to match the demand such that it does not result in an inflationary condition. That's what we're saying. That is the reason we thought we're working together, but let's work in a way that we can achieve what we want to achieve in a way that does not continue to hurt the economy. Now, what is the impact of the flexible FX regime? First, at this time, CBN has retreated. CBN is not the dominant player in that market, because we've seen, like I said earlier, up to $1 billion in 2 to 2.5 months. That dollar was sold in the market, but I can tell you that the CBN did not inject $1 billion or more than $1 billion into this market. So CBN is not dominant player. Well, for those banks that are not accepting dollar cash, we'll try to encourage them to accept dollar cash so that people can transact or do their remittances as they wish. Wall Street Journal, given US Fed and Brexit, are we considering diversifying FX reserves to yen. Well, I must say that the Central Bank of Nigeria, amongst other central banks of the world, was, I would say, one of the foremost central banks that considered the idea of diversifying reserves away from the dollar. And of course, we currently have some of our reserves denominated in the yuan, the Chinese currency. We would continue to monitor the situation in the international FX market, and based on that, we may take certain decisions. But at this time, it is not a matter that is right on the table. The FX sale to BDCs. I must again say that it's regrettable that what we did is to see how the dollars from the international money transfer operators can flow to the BDCs from them, so people who want to buy foreign exchange through the BDCs at the limit of not more than $5,000 cash can access those foreign currencies. Yes, we have received the reports, and the management of the Central Bank of Nigeria is looking at various options as to how to ensure that these funds flow directly to the BDCs so that we can moderate and dampen the prices in that market. And if need be, we would change the existing mechanism that will ensure that these dollars actually flow directly to the BDCs. Now, I would like to appeal, when you say that some banks or bank officials are collecting tips, I plead with you, please provide us credible information. We encourage whistleblowing. Be bold to bring up or mention the name of any bank official or any bank that is involved in requesting for brokerage in order for them to sell FX to the BDCs. The central bank has determined a particular rate at which these BDCs could sell, just like at which the banks can sell to the BDCs. But if we find a situation where some banks are trying to undermine the intention of Central Bank of Nigeria, please report them so that we can deal with this as appropriate. MPC hasn't been able to tackle volatility in the FX market. I would say I do not totally agree with you. When you say that we have not, naturally, do not forget that we had for 16 months, we had a peg. And when the market was released into the current flexible exchange regime, what you will expect is that because of the supply shortages and the supply shock, prices will naturally move up. But with the inflow of FX capital into the market at this time, which is looking encouraging, we expect that the price will moderate. But when you say that you are comparing that to the parallel market, I'd like to seize the opportunity to say this, that the only player in that market that our foreign exchange regulation recognizes are the players in BDC market. The BDC market by regulation are not supposed to deal in wire transfers, one. The BDC operators are not supposed to deal in the sale of cash to anybody of volumes above $5,000. We have noticed this and we are monitoring those BDCs. Indeed, we are also monitoring the activities of people who are involved in doing what we call free funds or illegal money transfer. These are illegal, and I had cause to even tell the banks, as well as those that are suspected to be involved, that the banks should submit their names so that we can cancel them. I like to use the word cancel them rather than use any other rude word. Bloomberg, should we take it that we have paused the tightening if we've paused tightening, we will say so. What we said in the communique is that the MPC will continues its tightening mode, albeit by retaining the rate as it is right now. It's not essentially the same thing as easing. So that's the position at this time. But the ultimate objective is to say, yes, at the last meeting we signaled that there was a need for policy rate to move closer to inflation. And moving closer to inflation does not mean that policy rate must move up. If, as a result of the action that we have taken, that we begin to see that even inflation is receding and coming down, that's the same thing as bringing them close. So it didn't mean, by our decision today to hold, that we had paused the decision rate at the last meeting. Other measures to reduce the spread between the parallel, I've told you, the parallel market has been contemplated, has been discussed around. One is a shallow market by our contemplation. That market should not carry more than 5, maximum 10% of the market. And we cannot allow a scenario where the tail should wag the dog. The dog must wag the tail. And that means that it is unfair, and I see someone to say so, that when you want to determine the value of our currency, you decide to use the rate in a market that we consider shallow, the rate in a market that we consider to just be about 5% of the entire market as basis for determining the currency. The Monetary Policy Committee does not do that, and we will not do that. It's just like I said in some interviews, that you get into Heathrow Airport, you buy foreign exchange at whatever rate the travelers man sells to you. But that does not form the base for determining the effective interbank rate in the United Kingdom. If you cannot do so in the United Kingdom, why do you want to do so for Nigeria? It is unfair, and I think it's high time we stopped thinking in that direction. Thank you very much.
Thank you, Governor.
Tax rate. What we meant is that yes, really in the US, in some other economies, we've seen a situation where when we have situations like this, there are those who are naturally vulnerable, the weak, the low income, and the middle income people. What you can do is to reduce their tax rate, and for the rich, and increase their tax rate so they can pay more, and this balances out. In fact, you can increase more for the higher, so that the disposable income for the poor, for the vulnerable, for the mid-income earners can increase so that they can pump liquidity and use it to boost consumption spending. Thank you.